Today was, simply put, an amazing day of never-befores and not-sinces. Never before has the Dow Jones Industrial Average dropped as many points as it did today, 1,190. Never before has the S&P 500 dropped so far, so fast, from an all-time high, diving 12% into so-called correction territory after hitting a record high just a few days ago on Feb 19.
And you were warned it was going to be a rough opening on Wall Street this morning. Stocks actually around the globe have been really taking a hit. The U.S. stock market futures takes a dive over fears of a spike over the global threat. That's what's behind this. Down 3.27% here, almost 1,000 points.
Where is, if anywhere, that support that may put that floor under this?
I think we just have to realize that this is a market now. We're not in modern portfolio theory. This is behavioral finance. And I think there's a lot of psychology that can be sort of interpreted based on these squiggles that you're seeing in the chart. Keep in mind, we were sideways for 2 years. The market sentiment 2 years ago by some of the largest hedge fund managers was bearish, was underinvested, and was outright short. We've just recently broken higher. So I think there's this general disdain right now for this market.
Hey guys, welcome to Market This Week. I'm your host Tex, and I just want to thank you for spending this time with me today. So in this video, we're going to discuss the latest headlines after the stock market recorded its worst week since the financial crisis. We'll also take a look at the technicals for the major indices, the futures, and just see how some of the sectors and the largest companies ended the week. And finally, we're going to take a look at my dividend growth portfolio that I have with M1 Finance, and I'll share with you just how bad the losses were. This is something we're going to look at through the good, the bad, and the ugly, guys. We're going to see what it's like to actually have money invested in the stock market through the good times and the bad times, and I will share it all with you right here. If you do like the video, please hit that like button. I do appreciate that. It does help me out. So we've got a lot to cover. Let's go ahead and get started with the video. All right, guys, so this article really says it all. Global stock markets have lost $6 trillion in value in 6 days. Absolutely incredible. The U.S. stock market alone losing $4 trillion of value in that same time period. So, the severity of the sell-off is alarming, but also the speed of the sell-off, I think, was the more alarming part, at least for me and a lot of investors. This article from the Wall Street Journal, stocks suffer biggest weekly losses since 2008. Absolutely incredible graphic here. You can see that we are well below that 10% correction threshold. At one point, we actually fell just a hair under 15% in 1 week. To think about that. We almost fell all the way down into bear market threshold, down to 20%, just about 4%. 4.5% maybe shy of that. I'm not sure of the exact number, but you can see from the graph very, very close. To put that into perspective, the last time the market fell 20% was back in December of 2018. And from its all-time high down to that 20% drop took about 2.5, 3 months, I believe it was. And we fell almost 20% in 1 week. Just 1 week. Absolutely incredible. Dow Jones Industrial Average falling 12.4% this week. A drop of more than 3,500 points, and of course capping off its worst month since 2009 during the financial crisis. All 11 of the S&P 500 sectors have fallen into negative territory for the year. About 95% of stocks in the broad index are now down more than 10% from their highs. Also, the 2-year yield, which typically moves with expectations for central bank policy, slid to 0.878%, and that was its largest 1-week decline since September 2001. About $18 billion left U.S. stock, mutual funds, and exchange-traded funds, or ETFs. So definitely some people heading for the exits in those ETFs and mutual funds that they're invested in. Around the world, just about every stock market here falling into correction territory. Europe down 12%, Japan down 9.6%. So it's being felt all around the globe. Clearly, everyone really, really hurting. But the selling remained particularly acute in areas such as travel and leisure stocks, which of course makes sense given the news. A lot of people are probably going to cut back on traveling, or at least unnecessary traveling. That's going to impact airlines, hotels, travel agencies. All that type of stuff is really getting hit hard. Cruise lines in particular. Southwest Airlines is one stock that gives you a really good perspective of just how much this drop was and how quick this drop was. Just 2 weeks ago, Southwest Airlines was at a 52-week high, and it's now at a 52-week low. To fall from a 52-week high to a 52-week low in only 2 weeks is absolutely incredible. U.S. crude oil prices logged their worst week since the financial crisis, and they've already been really hurting. But of course, it makes sense because there is the fear of slowing demand for oil, and that will directly impact those oil prices even more so. Bank of America lowered its estimate for global economic growth. Goldman Sachs, in fact, saying that it's expecting 0% corporate earnings growth for 2020. So without any type of corporate earnings growth forecast, it's very difficult for stocks to really see any capital appreciation. So until that changes, I just don't expect any kind of significant rally in the stock market. I think that more likely we could see more volatility and possibly more downside. And also, finally, from this article, just a testament of that volatility, the VIX jumped to 40.11. So it's the highest close since August of 2015. So all of the volatility that we've had over the past couple of years wasn't as high as what we've seen since August of 2015 here on the VIX. So definitely very interesting. This graphic is interesting because it shows just how fast we fell. The fastest 10% declines in the S&P 500 from an all-time high since 1980. And here we go this past week, almost twice as fast as the time before that, which was in February of 2018. So very dramatic decline. This graphic also interesting. It's showing us the market corrections since World War II. We can see the 26 corrections have averaged a decline of 13.7% over 4 months and have taken 4 months to recover. Okay, so we already hit that 13.7% in 1 week. So who knows what's going to happen as far as the recovery, but just to give you some perspective of what the kind of average is for market corrections there, and we're breaking records left, right, and center. And another interesting article here, just to kind of give you a testament of people heading for the exits. Vanguard and Fidelity suffer brief outages on Friday. So many clients trying to log in and sell positions, they couldn't access their accounts. So, this could give us some insight as to what can happen when there's a mass exodus for everyone to get out of the stock market. It can get really, really ugly very quickly. So, that kind of gives you an idea that maybe there was a lot of panic, and you could certainly say that when you look at the charts. But this article from CNBC was a little interesting. It was talking about, they saw everything except panic. So they do admit that while the selling was aggressive, there was little sign of panic. This chief market strategist from TD Ameritrade said it's been incredibly orderly. Basically just saying that market trading volume is about where it should be. Orders are getting filled, though the spreads are wide between what the sellers are asking and the buyers are willing to pay. But retail clients have been relatively calm, he's saying here. They do mention, the lack of panic, in fact, may be negative. So what we want to see for a bottom in the market is kind of capitulation. And that only comes when you get past that peak panic. So, they're saying that the market is waiting for peak panic and it's waiting for capitulation. So basically where it's exhausted. And if they're right in this argument, then that means that we haven't yet seen that. So we could expect more downside in the market before things get better. So that was definitely interesting. So as far as our Fed is concerned, yes, it looks like, they're already coming out saying they will act as appropriate to support the economy. So it's already being priced in that they are going to cut rates. However, I don't think that it's going to have a significant impact. Other articles were basically saying the same thing. This isn't a financial crisis. This is a biological crisis. And the problem is that we don't have any precedents. This has never happened before. So we don't have any historical data that we can look back on to say, okay, this is what happened then. Everything's very different today than it was then. I think that the Fed cutting could have some impact, but I just don't think it's going to have the type of impact that, it would under different circumstances. This article here is just really kind of talking about the shrinking profit prospects. And this is, in my opinion, I think the biggest threat to stocks, because you've got that uncertainty of earnings growth, what companies are actually expecting to make. Goldman Sachs again here forecasts that U.S. companies will generate no earnings in 2020. So that's really significant. And when you've got the market trading at levels that are incredibly high above earnings, you see right here, as investors assess rattle markets, they see stocks that still aren't particularly cheap. The S&P 500 was trading Friday at 19.8 times its past year's earnings, compared with a 5-year average of 20.1. So when the market is trading at 19.8 times its earnings, and then you have estimates coming out that there's going to be zero earnings growth this year, of course the market's going to fall apart. It's impossible for the market to have any capital appreciation if there's not going to be any earnings growth. That's a major driving factor for stocks to go higher. So unless that changes, then I would say it's going to be difficult for stocks to go higher in the short term. So far, earnings estimates are generally holding up for later this year, though. It does say that profits in the second quarter are expected to rise 4.1%, but that is slowing from an estimate of 5.7%. So for the full year, earnings are expected to climb 7.3%. Again, that is down from a projected increase of 8.7%. But this can all change. Again, this can get worse or it can get better. So this is what we know now, and this is what the market is pricing in as of now. So if these estimates hold true, then I would say that stocks do have a really good chance of recovering later this year. If things just get progressively worse throughout this year, then I'd say that really is the biggest danger to push us into a recession. And the last article I want to go over here is just kind of talking about what can happen if you flee the stock market for cash. So, the big investment funds, hedge funds, and all of that, they have to sell positions when stocks, the stock market takes a dive like this. But individual investors, when you've got a long time horizon to work with, don't have to sell positions, and you're usually better off just staying in the market. So this article kind of touches on what can happen if you don't stay in the market. For example, this is just saying if you had invested $10,000 in the S&P 500 at the beginning of 1999, it would have grown to $30,000 by 2018, and that's provided you didn't sell it and you didn't add anything to it. You just put $10,000 in and just left it in there. Okay. Now, obviously, as an investor, you're going to be constantly adding to your positions over the years as you save more and more money, and you benefit more and more from that compounding interest. But this point right here was the most alarming one. In contrast, if you missed out on the 10 best performing days, just 10 days during that 20-year period, you would have cut your returns in half. In half, guys. That's the big catch right there. So it's all about time in the market and not timing the market. So, with my portfolio that I just started to invest in dividend growth stocks with M1 Finance, the timing is definitely unfortunate. When I first started to invest was right at the start of the sell-off. So I've added in on the way down, but it's the timing is unfortunate, but given my long time horizon, it's more important that I get in the market to make sure that I don't miss those 10 best performing days during a 20-year period. And just really alarming to see how big of an impact that can have on your returns. So with that said, that's about all the news that I want to go over. Let's go ahead and jump into the technicals and see how things shaped up there. Okay, so we're going to start out by looking here at the S&P 500 futures. Really incredible daily chart, gives you some ideas to the extended move that we've seen. If we measure this out roughly from all-time high to the low of that sell-off, that is about a 15.9% drop. So where we closed, it's right at about 12%, as we discussed from our news articles. So again, a 15% drop in that short period of time, absolutely incredible. We crashed right through that 200 SMA right there. We also crashed right through some significant trend lines that we were watching in previous videos. Where we ended up finding support was this low right here. So if you were watching the market back last year in August, we had this volatility come in here and we got stuck in this range. Then we tried to break out here of this range. We pulled back, came into the 200 EMA right here, found support, and then boom, that was the big breakout move from that was around October of last year. Big breakout move that played out all the way into February of this year, and that was an increase of about 17.3%, right about that area. And we gave all of that back. You can see that where we are finding support is right across that line right there. So that's where we bounced. And if we look a little further out, we actually also, that comes in roughly around a previous all-time high back here in January of 2018. So very close to that as well. That's a pivot high, very significant level. So yeah, it puts things into perspective. But what I want to do is go to a monthly chart and take a look at this. So I've highlighted previous drops in the market just to give you some perspective. This was the tech bubble, and the market, the S&P 500, falling roughly about 50%. Okay, and it's bouncing right off of that 200 EMA on the monthly chart. Then we bounce up here into basically a double top, and this was the financial crisis in 2008, and we see that it falls 58% during that recession. So the 20 EMA on the monthly chart has done a pretty darn good job of discerning bull and bear markets. For the most part, it tends to stay above it during bull markets, and you can see it falls below it in bear markets, recover from the tech bubble, back above the 20 EMA, riding it up into the financial crisis, breaks below it. There's a huge breakdown during that crisis, getting back above the 20 EMA, really flirting with it throughout this period, and then riding it all the way up into 2015 and 2016 when there was a lot of uncertainty in the market there. You can see during that time frame that we did fall below the 20 EMA, the 50 EMA holding us up right there. So that 2015 and 2016 correction there, about a 15% drop there. And then we have another big run up here into the correction of early 2018, February 2018. So that was about a 12% correction right there. Push up into a new all-time high here. And here was our last major correction. Again, this was between October and December of 2018. That was your 20% drop there, coming into the 50 EMA. So again, that 20 EMA tends to be really key to give us some insight as to whether we're going to have more significant move lower, or if we're going to just correct into that and continue trend higher. So that's your S&P 500 futures, especially the monthly chart. One thing that I wanted to go over with you. If we go and look at the NASDAQ futures monthly chart, the NASDAQ futures hasn't made it to its 20 EMA on the monthly chart. So it's got a little bit further that it could fall. And given that, I'd say that also supports the idea that the market might still fall a little bit more. I think the NASDAQ futures might want to get down into that 20 EMA as well. All right. So interesting that it hasn't quite fallen down there. Let's go look at our weekly chart. So on our weekly chart, the NASDAQ futures bouncing off that 50 EMA right there. And then we go to our daily chart, and this is really, I think, key. So the bounce comes right here off the 200 SMA. Okay, so I have the drawn lines here. These are EMAs, and then these just single little marks right there and there. Those are SMAs. All right, and so we can zoom in on this and see how perfectly the NASDAQ bounced right off of its 200 SMA. Falling below that, that's definitely going to open the door up for the NASDAQ futures to at least fall down into that 20 SMA there on the monthly chart. And then we'll have to reassess and see where things are at that point. Now, one thing that's really interesting, I wanted to show you this. If we go to an hourly chart and we switch over to our Fibonacci predictions here. Now, again, I've discussed these before. Between the orange lines and this dash line, this is generally considered like fair value. You get above or below, you're getting overbought and then oversold. Okay, and now these were put on the chart based on the previous month's price action. So this is based on January projected into February. Okay, and so obviously tomorrow and Monday we start a new month in March, but look at how nicely this actually played out. As we sell off, okay, we fall into a fair price area here. We open right at that 20% and we come right down into the 80% and bounce. We bounce up into the 50%, fall back into that 80%, and then we break. And then we start to find acceptance in the next level down, in the next fair price level, right? We bounce, we reject, and we fall down into the 50, down into the 180 there. Again, bouncing, rejecting, and then we move into the next fair price area. So you can clearly see it on the chart, right? We trade within one fair price area here, right here, and then we trade through another fair price area here, and then we end the week trading into this fair price area right there. So very, very interesting, and basically 3 legs down through 3 fair price zones, and then now we're starting to push up and come back in to test this previous fair price zone that we were trading in back here through Wednesday and early Thursday. So amazing how well that works. I would keep an eye on this previous fair price zone here. If the NASDAQ pushes up into here, probably going to be significant overhead resistance here. And then you're going to have some of your weekly moving averages that are going to be coming in. Your daily moving averages come back up here. Your 50 EMA, your 50 SMA is going to be coming up into this upper end here of that previous fair price zone. So as we trade up into this fair price zone, a lot of overhead congestion right here. You're going to have resistance from these days here, and you're going to have your moving averages just over that. So if we do continue to bounce up, somewhere right here in this area is probably going to be realistic, because that's where your next big overhead congestion is going to be. But first, we have to get through this fair price zone before we can get up there. So very, very interesting. Let's just take a quick look at the Russell. Significant drop. And where did we come down? Right into the bottom of that channel. So that channel still being respected. That's right where we bounced, and timed almost perfectly with the NASDAQ hitting its 200 SMA on that daily chart. So you get the NASDAQ hitting the 200 SMA, you get the Russell hitting the bottom of that channel, and you get the S&P 500 hitting that very key support level all at the same time. Makes sense that we bounce right up there into the close on Friday. And then finally, just take a look at some of the sectors. Absolutely incredible, getting crushed all around. There's your financials, just straight down, industrials, technology. Nice bounce on technology, definitely bouncing right off of its 200 SMA there as well. Consumer staples, significant drop, bouncing up there into the close. Utilities, which, utilities usually do better when the market sells off, but they've been so overbought lately that they really needed to correct. So it's just widespread around the entire market. Even the safe haven stocks, the dividend paying stocks that I've invested in, even they haven't done that well. So significant drop there in utilities. Then you've got healthcare, you've got consumer discretionary, and you've got communications right there. Here's your real estate. So real estate usually does pretty well, but again, just widespread all across the market. Semis held up relatively well. Definitely sold off, of course, but they did bounce right here off of that 200 SMA as well, along with the rest of tech. And here is your 20-year bond. Of course, that's going to go up with the market selling off, but this is just getting a little ahead of itself, the same as the market selling off. Bonds really getting bought up hard. So if the market bounces a little bit, we'll see a pullback in bonds. If we pull back and find support, this previous breakout zone, we might see a reversal in any bounce on stocks and see those go lower and bonds go higher. So you could certainly watch TLT in regards to that. So like I said, guys, widespread sell-off across the market. We're seeing every single sector with significant moves to the downside. A lot of buying opportunities if you have long time horizons, but I think that you probably want to ease into it, because we could easily see more downside in the short term before things get better in the end. Okay, guys, so finally I want to go over my dividend growth portfolio that I have here with M1 Finance. So I think the first thing that you're going to notice is that the value of the account is up dramatically, currently sitting at $10,771. Now, no, the account didn't go up in value even though the market sold off. It's because I was continually adding money into the account this past week as the market was selling off. So every single day this past week, I added more money to the account. That way I could just keep cost averaging down as the market was selling off. Admittedly, I didn't expect the market to sell off as much or as quickly as it did. So I probably got a little too aggressive early on adding into this account and adding to these positions. But I have the money in the savings account that I was planning to divert into this account anyways. So given the speed of the sell-off just meant that I was going to be contributing money to the account a bit faster than I originally planned. I was basically going to just slowly add money into the account, assuming the market didn't have some big pullback, and that way I could just slowly cost average in over time. But given the amount of the pullback that we were gifted essentially this past week, I added more aggressively into the account. That way I could cost average into these positions a little bit better and take advantage of, a lot of these stocks that are really on sale. So that's why the account value has grown. Certainly we can see that the account is down $720.26 right here. However, we have earned $7.92 in dividends. We haven't actually received the dividends yet, but that is the dividends that we have earned so far. So that's really nice. We'll also take a look at a spreadsheet I created in a minute that'll give us an idea of just how much in dividends I'll make every year on the account as of now, as of what I have invested. You'll see the return is down 11.92%. That's huge. But I would mention that the way they calculate this return is actually a money-weighted return. I don't know why they choose to do that here. So it's going to make it look worse or better than it really is. If you want to see your true return, you can go to your holdings page here. This is obviously a list of all the stocks that I'm invested in, which as of now is 22 stocks. If we scroll to the bottom, you can see that I'm technically down 6.33% or $728.27 on the account. Now, with a dividend growth portfolio, capital gains are not as important. Of course, they play a role. You want some capital gains, but what we're more focused about is the growth of our dividend payments over the years. Eventually, we want to get to the point where we are making enough on dividends to simply live off the dividend payments and not have to touch the principal. That's the idea behind the concept. However, I have focused on putting some growth stocks into this portfolio, so we do get some of those capital gains. For example, like Microsoft is one of those. If we go to technology, Microsoft is going to be a big one in terms of capital appreciation, but they do pay a dividend. It's a little over 1%. So that's why they're chosen to be in there. You can go through each of these and, choose the sectors that I've created in the portfolio, which are essentially pies. And inside each of those pies or my sectors are the companies that I'm invested in. So you can click on each of those. You can see the allocation that I have for each company within those sectors, and then the allocation that I have for each of the sectors. And as stocks sell off, or as I lose value or gain value in particular stocks, you'll notice that the allocations will change between what the actual allocation is and what the target allocation is. So as I add money to this account, what M1 Finance will do is go in and invest in whatever companies that I'm currently underweight in, and that way it tries to keep the portfolio as balanced as possible without having to sell any positions. It's basically called dynamic balancing, and it makes it super easy because it just does it for you. So I just simply, choose what companies I want to be invested in, set, what the allocations I want them to be, and then M1 Finance does the rest. As soon as I put money into the account, they automatically invest it. So that's very nice. So overall, we're seeing the ugly here. We're going to see the good, the bad, and the ugly, and this is definitely the week to see the ugly. If we start to see a little bit of a bounce in the market, we'll see some of these positions improve, but I don't expect in the short term we're going to see any significant improvement. We're probably going to be red on the account for a little while before things do get better. And finally, I just wanted to show you the spreadsheet that I created very quickly here. This is for my dividend growth portfolio, and I did this so that I could just very easily keep track of my positions and how everything is performing on my own, separate from M1 Finance. But basically, it's straightforward. This area over here is everything that I have to manually input, and then the rest of the spreadsheet automatically calculates out things like the current market price, the cost basis, the change in dollar loss and percentage, loss or gain. The most important column that we want to be paying attention to as a dividend growth portfolio is our annual income. So if we look at this, as of right now, my annual income on my holdings is $406.51. So basically my money being invested in these companies is making me $406 a year just sitting in the market and not doing anything. That is passive income, and that is really the goal of a dividend growth portfolio. As I continue to add money to the account over the years, and of course the account value grows, those dividends that I receive get reinvested, and you get that compounding interest really working for you. This annual income number will really shoot up higher and higher and higher, and eventually, again, the goal is to get to the point where the amount of money you're making annually on your dividend payments is enough that you could live on, and you'd never have to touch the principal that you have invested in those stocks. So definitely a sea of red here on the spreadsheet, but again, not to be surprised. And just a couple of graphs down here to give you an idea of the individual company weights, the sector weights, and then I have a separate page here. Now this is not currently accurate. I just put some numbers in here to make sure that the graph is working correctly. But the goal of this page is to track each of the dividend payments that I receive from the companies I'm invested in, and this way I can kind of see how my dividend payments grow over time. So that's really the purpose of this page. Since I haven't yet received the dividend payment, obviously there's nothing to enter here. So again, this graph is not accurate, but we'll see how this grows over time. And then this is just a page that I created to enter actual transactions or order executions. That way I can track them for my own personal records and for tax purposes as well, because this is a taxable account. So with that said, guys, that is everything I wanted to go over with you today. If you have any questions, again, please feel free to post those in the comments below. I'd love to start a Q&A segment where I can address some of your questions live on future episodes. So if you'd like for me to do that, feel free to post those below, and I will certainly accumulate those for future episodes. If you found the video enjoyable, really do appreciate it if you hit that like button. That really does help me out, guys. And as always, I hope you're doing really well. Have a great rest of your weekend, and I'll catch you guys in the next one. See ya.